Mortgage rates have felt like a stubborn ceiling for 2 straight years, hovering between 6 and 7%, and even spiking to a hair raising 7.79%, a level Freddie Mac hadn't recorded in decades. That run up is a whiplash reversal from the pandemic's rock bottom 2.65%, a rate born of emergency Federal Reserve policies that most economists agree we may never see again in our lifetimes. Still, today's borrowers naturally ask the same question at every open house. When will we slip back under 6%? And is it worth waiting? To guess where rates land, you have to watch the same dashboard the bond market does: inflation gauges, Fed meetings, and the slow grind of unemployment data. The central bank's own projections point to 2 cuts in the federal funds rate before the end of this year. Those moves should pass through to mortgage pricing, though only partially, nudging the average 30-year note toward the mid-6 range. Fannie Mae's June housing forecast sets the stage for a 6.6% average by the close of the third quarter and 6.5% at New Year's. The Mortgage Bankers Association is even more cautious, penciling in 6.7% to finish 2025. Both sets of forecasters stop shy of anything that begins with a 5 until at least 2026. And that is where most analysts draw the invisible line. Sliding below 6% will likely require cooler inflation, a bump in joblessness that persuades the Fed to cut more deeply, and a broad vote of confidence from global investors who treat treasuries and mortgage bonds as safe havens when geopolitical sparks fly. That mix of lower prices on consumer goods, softer labor demand, and geopolitical calm is hard to picture in the current macro backdrop. Tariffs announced in the final year of the previous administration are still rolling through supply chains, pushing component costs higher. Meanwhile, uncertainty over who will replace Fed Chair Jerome Powell next spring clouds the longer-term outlook for monetary policy. All of that explains why Fannie Mae projects the 30-year fixed at roughly 6.1%, even at the tail end of 2026, and why no major forecast today shows a conventional loan priced in the 5s before then. The practical effect of staying north of 6 is easy to see when you line up real payments. At today's median sale price of roughly $417,000, the average 6.81% rate translates into about $2,700 in principal and interest every month. Strip 1 percentage point from the loan coupon, and that payment drops by roughly $270, saving more than $3,200 a year, enough to swing a qualification in or out of reach for many first-time buyers. Add insurance, taxes, and mortgage insurance, and the bite can easily chew through half of a typical household's annual earnings, a share far above the old rule of thumb that housing shouldn't take more than a third of your paycheck. So, should you sit on the sidelines until the calendar turns to 2026? That answer depends less on chasing the perfect rate and more on what you can control. Sellers have adjusted to the new normal, and price growth has cooled in many markets. If you find the right property and the payment fits your budget, at today's rate, a future refinance can still bail water for you later. Lenders call it the marry the house, date the rate strategy. In the meantime, borrowers can shave the note by polishing credit scores, lowering debt-to-income ratios, or paying discount points up front. Small moves that chip away at monthly cost, even if macro forces stay stubborn. If you do decide to wait, monitor the Consumer Price Index each month and pay attention to Fed language after the July meeting. Those are the early breadcrumbs that signal whether forecasts need adjusting. And remember, a true sub-6 rate across the board will not be an overnight event, but a gradual glide. Lock opportunistically keep a refinance in your back pocket, and frame expectations around a marathon, not a sprint. The bottom line is that today's elevated rates are unlikely to linger forever, yet the journey back into the fives looks more like 2026 than 2025, unless inflation surprises on the downside and the global stage calms dramatically. Until then, the smartest play may be preparing your finances so that when the window finally opens, you're the first borrower through the door.